Hi there, welcome back to Dukascopy TV. I'm Ben Jones. Alongside me once again in the Dukascopy TV studio is Ron William to discuss the increasingly high levels of the stock market. Ron, thank you very much for joining us again.
It's a pleasure to be back, thank you.
So I'd like to begin by discussing the stock market, and we're continuing to see record highs. However, some believe that there is still the bubble. Can you discuss the reason for these record highs and the bubble?
Sure. On the opening chart that we have here on the screen, we can see that we've been making record highs on the S&P 500 in this example for quite some time, certainly throughout the first half of this year, 2014. But what is very important is to take a big picture perspective of this very optimistic, very positive move that we've been seeing. And so on this chart here, I'm trying to put the recovery that we've seen since 2009 into context of other recoveries that have taken place over the last 10 plus years. And so we can see here the recovery that we're currently experiencing is a recovery gain of 198%. So it's almost doubled in value over 65 months, which is roughly 5 years. And that's similar to what we've seen in the cyclical recovery from 2002 to 2007 when we had the global financial crisis, and also similar to what we saw into the technology, media and telecom bubble, the tech bubble. In the example of the run-up into 2000 from 1995, the price gain was actually quite exceptional, 251%, and that was largely based on the fact that that was a very long-term bull cycle all the way from 1982, so that had quite a long-term upside potential. But coming back to here, what this does suggest is that this is akin to other bubbles that we've seen in 2007, global financial crisis, and the tech bubble in terms of the technical setup measured in price and time. So the market is very extreme in both those measures. The second thing is, what's interesting is that one of the key sell signals to watch out for, if and when the market does become exhausted and then reverse on the downside, is just by looking at simple moving averages, the 10-month and the 30-month moving average. We can see here that in the previous crisis events, there was a negative crossover, a bearish crossover signal, and this is something that we're looking for at right here, right now. So the key levels that viewers should be keeping an eye on would be 1850 and 1610. These are key levels to watch out for over the next coming weeks and months. The additional point I would make here is seasonally, these big corrections tend to take place during the August to October period. It's a big drawdown period for the equity market. And we can see here, just here in the red highlights, B and A, that's when we did get the big sell-off during the previous crisis events.
Okay, now what impact is the midterm presidential election having on the market?
Well, this is quite an important additional factor to keep in mind that will increase the probability of downside pressure in the second half of this year, actually the fourth quarter of this year coming. And if we just look at the chart here, I'm making a comparison of a previous long-term bear cycle, 1966 to 1982, which is similar to the current long-term bear market we're in from the year 2000 to date, where we can see that the market corrections and bottoms are marked by the midterm second year of the presidential elections in the States. What we can see here is specifically in 1974-75 was the re-election of President Nixon, and the fact that we got a very sharp drawdown during that period. Now, the premise behind this is that the midterm is the lull before reinvestment from government in their new campaign for the next presidential election. And so what we see here in 1974-75, that big correction, which followed a record market high, similar to what we've seen right here, right now. And so I've mentioned it here in 2014, deja vu potential, where we might have further downside pressure in the market as we head into the mid-year presidential elections in Q4 of this year.
Okay, now in terms of volatility, the market tends to seasonally spike in Q2. But for the past few years, this hasn't happened, and we're back to the same levels that we saw in 2007. Does this pose any risks to the market?
Well, in my opinion, it does. Every action in the market leads to a reaction, and right now the action is super historic complacency. We haven't been as comfortable as we are now as investors and traders as pre-2007 financial crisis. So on the one hand, that's great. On the other hand, it makes you wonder how long will that last? Could this be the calm before a potential repeat storm? History does repeat, but in different variations. And so here we see the measure of volatility and sentiment in the market, the VIX measure, seasonally spiking in the second quarter of each year, as you just mentioned there. But for most of this year and early last year, we haven't seen that much volatility. It's been a well-known and frustrating story for most people. But at the same time, at this moment, it does suggest that having revisited the historic lows and reversed up higher, that we're likely to see further upside mean reversion potential. And because we haven't seen that seasonal volatility that we usually see every year, it just increases the probability of this happening sooner rather than later. And what I've highlighted here is this volatility breakout risk from a 2-year compression. So for 2 years, the volatility has been compressed. And if we look at the S&P 500, we haven't seen a 10% correction in just over 2 years. So this abnormality is likely to unwind in some shape or form. The key level is 22% on the upside as a key trigger point. And the only other last point I'll make is this is all taking place despite multiple black swan events, i.e. extreme market events, such as the technical and sentiment extremes that we're seeing in the market, the economic and recent systemic risk that we heard coming out of some of the European banking sectors. And then lastly, the ongoing geopolitical risk, which we've seen in Eastern Europe and the Middle East. All of these things are still continuing and brewing in the background, and yet we haven't seen the events transpire on the market. So something to watch out for in the coming weeks and months.
Fantastic. Ron, thank you once again for coming into the studio today.
Thank you very much. It's been a pleasure.
And thank you for watching. Do make sure you keep clicking back to Dukascope TV for plenty more updates and exclusive interviews. Bye for now.